Flash Eurozone PMIs just out, as always 2 minutes ahead of the market on Reuters. The composite number dipping to 47.3 in February, that's from 48.6 in January. Rob Dobson from Market, who compiles those numbers, joins me now. Rob, there's been a lot of talk about the Eurozone on the cusp of recovery, exiting recession. These numbers suggest that talk's a bit premature, no?
It does. What we've seen this month is a sharpening rate of decline in the Eurozone as a whole. So again, that would suggest that on the cusp of recovery, a bit premature. But what we should see is that rate of decline in GDP possibly ease in Q1, which again positions us for hopefully moving out of recession Q2, maybe Q3.
So what you're saying is Q1 still in recession, that exit will be put back to Q2.
Q2 or Q3. What we're looking at is it was a 0.6% contraction in Q4. These figures at the moment so far in the first quarter, probably consistent with that easing to around 0.2 to 0.3%.
Okay, so what's behind this weakness? I mean, I thought things were meant to be improving.
Well, there's two pictures behind this. Firstly, there's a big divergence between stronger performing economies like Germany and weaker performing economies like France. What we're also seeing is, in a lot of these countries, the domestic market is still very, very weak. Where we're seeing some of the growth more in places like Germany, where they're having a bit of a boost from export orders and from the domestic market not being as weak as elsewhere.
Those you say if export orders are doing not so badly, that would doesn't seem to make sense, given that the euro's appreciated so much in the last 3 months.
Yes, but the effects of that are being countermanded by effects such as US growth still reasonably okay, despite what we saw in Q4. And also we're seeing places in Asia, in particular China, we're also seeing reports of particularly Germany benefiting from this. And again, Germany's also benefiting from its domestic market not being as weak as elsewhere. Let's
go into Germany. It's a bit of a mixed picture. Manufacturing expanding for the first time in a year, but barely. And growth in services is falling, and the euro fell quite sharply on the back of those German numbers today. So a bit of a mixed bag, no?
A bit of a mixed bag. Now, the German service economy, again, that's benefiting from the fact that the domestic market is remaining pretty strong in Germany. And again, manufacturing, what we're seeing there is a little bit of a benefit from exports and some domestic demand. But yeah, it's a mixed bag. But if the German manufacturing sector is beginning to stabilise, that's positive for Germany, good cyclical indicator. And also factors such as low stocks and that increase in demand mean that maybe Germany could start to ramp up production a bit more in the coming months.
So just to be clear, Germany will escape recession?
Well, it won't escape recession, it will avoid recession. So
same thing.
Yes.
And finally, France. I mean, there's no escaping it. Pretty dismal numbers from France. Services sector contracting at its fastest pace in 4 years.
Exactly. What we've seen so far since the turn of the year is the divergence between the performance of Germany and the performance of France on the PMI numbers. Those indexes are the widest since data began in 1998. So this is a big divergence between the biggest economy and its second largest. And the fact of the matter is that Germany on its own isn't enough just to support the Eurozone as a whole, particularly if conditions are weakening to such an extent in France.
So how deep will this recession in France be, and how long will that last, do you think?
Well,
going by your PMI numbers.
Going by the PMI numbers are now well below 50, so we would expect to see at the earliest possibly in the second half of the year for France. But new order inflows are particularly weak in France, so again, where that growth is going to come from, we'll have to wait and see.
OK, Rob, thanks very much. That was Rob Dobson from Market. That's all for now. I'm Jamie McGeever. This is Reuters. All you need to know.